Hello, Econ 151 students. This week, Lesson 11 is Chapter 17, which deals with money growth and inflation. We're going to be answering a bunch of questions here and understanding the quantity theory of money, which is one of those 10 principles of economics from Chapter 1, and it tells us that prices rise when the government prints too much money. And while most economists believe that this is a good explanation of inflation, we need to understand a little bit more about that. So to get started, we're going to look at the value of money. If we identify P as the price level, and let's say that P is the price of a basket of goods measured in money, then 1 divided by P is the value of $1, what that $1 will purchase measured in goods. So an example of this, let's say we have a basket that contains a candy bar, and if the price of that basket is $2, then the value of $1 is 1/2 of a candy bar. If the price of that candy bar is $3 of that basket is $3, then the value of $1 is going to be 1/3 of a candy bar. So inflation drives up prices, drives that P or that price level up, and inversely drives down the value of money. Each dollar will buy less and less as prices increase. The quantity theory of money is something that was developed in the 18th century by David Hume and classical economists, and more recently we've seen it advocated by people like Milton Friedman, and this is the assertion that the quantity of money in the economy determines the value of money. So we study this theory using two different approaches. One, we can look at a supply and demand diagram and see it that way, and we can also understand it through the equation that tells us the same story. So let's talk about the money supply. In the real world, money supply is determined by the Federal Reserve, the banking system of all the member banks, and consumers. That's really where it comes from. In our model, however, we assume that the Fed only controls the money supply and that they set it at some fixed amount. So that's one of the simplifying assumptions we make. So even though the Fed really only influences the amount of money, we're going to assume for this that they actually set it. Demand for money refers to how much people want to hold in liquid form. And it really depends on the price level. And this is an important distinction to understand with money demand. The amount that people want to hold is going to be dependent on how much things cost. So if there's an increase in the price level, that's going to reduce the value of money. It's going to require more money to purchase goods and services. And the reverse is true as well. A decrease in the price level would actually reduce or increase the value of money, requiring less money to purchase goods and services. So you can see that the quantity of money demanded is negatively or inversely related to the value of money and positively related to the price level. So that's going to be something we'll see in our diagram. So let's take a quick look at the diagram here. We can see on the left we've got the value of money, which is that 1 divided by the price level. And then on the right, we've got the price level itself. And on the horizontal axis, we're measuring the quantity of money. So we can see is as the value of money rises, the price level falls. And you can see that inverse relationship. So here's the value of money on the left side increasing, and at the same time the price level is falling. There's that inverse relationship. We can also see that the Fed, if they set a money supply at a fixed value, regardless of the price level, so this is independent, right? When we see this vertical line here, we can say it's independent of either of these two values on the sides. So they set the fixed value, and they really aren't considering the price level when they make this decision. So what we're going to see is a fall in the value of money. It's going to look like this. An increase in the price level or a decrease in the value of money, right? They're inversely related, is going to increase the quantity of money demanded. So the money demand curve has that inverse relationship between the value of money and how much people want. So go back to that previous example. If the value of money goes down, you're going to have greater demand for the quantity of it. You're going to need more in your pocket to pay for things because each dollar buys less. And that's inversely related to the price level. Now let's put this together. So we can see that, let's say that the Fed has set this money supply at 1,000, and we have that inverse relationship between the value of money and the quantity of money, so that downward sloping demand curve, and we can see that there's an equilibrium point. And the equilibrium value of money is established here, where the two come together, supply and demand. Money is just like any other commodity. And so the equilibrium value of money is 1/2, and this is also shows us the price level is at 2 when we put this all together. Now let's see what happens if the Fed injects money into the money supply. So we would call this a monetary growth or something like that. So the Fed increases the money supply using whatever tools they're using of monetary policy, and let's shift that supply curve to the right to indicate that, and we can see the subsequent effects on our graphical analysis here. What happens? Well, with that increased money supply, we're going to have a new point on that money demand curve. The equilibrium value of money will fall. Remember that inverse relationship. The quantity of money, the greater money supply says that the value is going to be lower. So the value of money falls, and at the same time we find that new equilibrium price, and we can see that the price level has risen. So this is that story of the relationship between the money supply, the price level, and the value of money. So if we look at the adjustment process found in that graphical look we just took, we can say, well, we could see that the increasing money supply causes the price level to rise. And you might ask, well, how does this happen? Well, here's the short version of it. At the initial price level, an increase in the money supply causes an excess supply of money. We also have called that a surplus in the past. That surplus is going to be a market disequilibrium condition. And markets, in order to adjust and clear disequilibrium conditions, find ways to adjust the price down when there's a surplus. So in this case, people are going to get rid of their excess money. They've got a surplus. And so they're going to spend it on goods and services or make it available to others to loan, who then spend it. And the result is going to be an increased demand for goods. But the supply of goods isn't increasing. So in order to reach that new equilibrium price, prices are going to rise. And they don't just rise because we draw it on the graph. They rise because now there's greater competition among buyers, among the people that demand the money. So the price is driven up by that competition. And that's really always how it happens in markets. Whenever we have a surplus, we have prices that are adjusted by competition among sellers. When there's a shortage, there's competition among buyers, and that tends to raise the price. So this works the exact same way. Now let's look at how real and nominal variables are affected by these changes. Nominal variables are measured in monetary units. They are on their face. That's really what nominal means, on its face. And so an example of this is nominal GDP, or the nominal interest rate, or the nominal wage. All of those are as they appear on their face, and they are just the stated price or wage. Real variables are measured in physical units. So real GDP, the real interest rate, or the real wage are measured differently. They are measured in physical units, how many of something, quantity. Prices are normally measured in terms of money, right? We see that money serves as a unit of account, and so we can see the price of a compact disc, the price of a pizza, things like that. A relative price is the price of one good as it relates to another. And so when we say relative, we're talking about a ratio between two things. So a relative price of CDs in terms of pizza would be the price of a CD divided by the price of a pizza. And if we use the numbers that we have here, we could do a simple calculation and we could say 1.5 pizzas per CD. So each pizza costs 1.5, well, let me say it backwards. Each CD costs 1.5 pizzas. So we're looking at the price of something in terms of the other good. We saw that before with comparative advantage. So we're seeing that again. Relative prices are measured in physical units. Notice that this is measured in pizzas per CD, not in dollars. And so, because they're measured in physical units, we know that they're real variables. That's an important thing to know. Now let's look at the real versus the nominal wage. An important relative price is what we call the real wage. So the wage, the nominal wage, identified as W, is the price of labor, and that's measured in dollars, like nominal variables are. The price level is the price of goods and services. So for example, $5 per unit of output. Notice that that's measured a little differently. The real wage is the relationship between, it's a relative price, it's the relationship between the price of labor relative to the price of output. So we would take the wage divided by the price level, and again we have dollars attached to those two things. So we would say $15 per hour divided by $5 per unit of output gives us a measurement that is 3 units of output per hour. Notice that this is in physical units, 3 units of output per hour. And so this is going to be a real variable. The classical dichotomy is a theoretical separation of nominal and real variables. So even though we can see them differently, this is a theoretical separation, that the two are very different. Hume and the classical economists suggested that monetary developments affect nominal variables but not real variables. So what they're suggesting is that changes in the money supply, monetary developments, will change nominal variables, which are measured in dollars, but not real variables, which are measured in physical units. So for example, if a central bank doubles the money supply, Hume and his fellow classical thinkers would contend that all nominal variables, including prices, will double. Right? That's their assertion. And that all real variables, including relative prices, which are measured in physical units, are going to remain unchanged. And we have some practice in our homework this week that helps you to see that and practice it so it can make more sense to you. The concept of monetary neutrality is the idea that changes in the money supply, just like Hume suggested, don't affect real variables. It's part of explaining this classical dichotomy. So in the idea behind the neutrality of money would tell us that doubling the money supply is going to cause all nominal prices to double. However, because we're suggesting that it's not related to real variables, that it's not going to affect the real variables. So here's an example. Let's say that they double the money supply, and initially the relative price of CDs in terms of pizzas is the price of a CD divided by the price of a pizza, so what we saw before, with 1.5 pizzas per CD. Well, let's double the prices now. We still have the same relationship. The price of a CD divided by the price of a pizza is now $30 per CD divided by $20 per pizza, which gives us the same relative price. It is still 1.5 pizzas per CD. So the real variable given in terms of units, physical units of output, is unchanged. So this gives us a really clear picture of this idea of monetary neutrality. So if we compare this to the real wage and the same idea of the neutrality of money, we can see that the real wage also remains unchanged by changes in the money supply. So let's use that same example. The quantity of labor supplied doesn't change, the quantity of labor demanded doesn't change, total employment of labor doesn't change, and the same idea of neutrality applies to the employment of capital and other resources. So since employment of all resources is unchanged, total output is also unchanged. Remember, that's our real variable, total output measured in physical units. Most economists believe that the classical dichotomy and the neutrality of money describe the economy in the long run. The long run isn't really a period of time, it's a period of production. So when we talk about the long run, we're talking about an amount or a period of production in which all variables are, all inputs rather, are variable. In later chapters we're going to look at that a little more closely. The second way that we can look at how changes in the money supply affect the value of money and the price level is this formula that we look at called the velocity of money, and it includes the velocity of money. So we can look at the real wage and understand that the quantity of labor supplied doesn't change when the money supply changes. The quantity of labor demanded doesn't change. Total employment of labor is unaffected. And we can say the same thing about the employment of capital and other resources. Most economists believe that this classical economy and neutrality of money describe the economy in the long run. And we're going to look in later chapters at the short-run effects on real variables. For now, we're going to look at another idea called the velocity of money. The velocity of money is the rate at which money changes hands, and typically is seen as kind of the turnover of money as it moves through the economy from one person to another through one transaction or another. The notation we're going to use is price level times Y, which is output, that physical output, and that's what we're going to use to measure our nominal GDP. And so if we look at GDP as the price level times real GDP, we can get a picture of the overall level of production in the economy. M in our notation is going to be the money supply, and V is going to refer to this velocity of money, this rate at which money moves through the economy. So the velocity formula, if we want to kind of rearrange it here, is P times Y, which is our nominal GDP, divided by the money supply. And the idea is that money moves at this rate. So if we take the velocity formula and we'll apply it to an example here, we've got a pizza. In 2012, let's say that real GDP was 3,000 pizzas. The price level, or the price of a pizza, because we're going to say that each individual pizza has a price of $10. Then if we put those two together, our nominal GDP is going to be the value of the pizzas, nominal meaning on its face, of $30,000 for that. If the money supply is, and we're just picking numbers here to make the formula work, $10,000, and the velocity of money, then using our formula, can be calculated as 3. Right? So if we plug in those values up here and solve for the velocity of money, we can see that the velocity is 3. And what this means is that number 3 tells us that the average dollar was used in 3 transactions. So it changed hands 3 times. So a little practice here, and I really like these practices that the PowerPoints provide for you. Let's say there's one good, and that good is corn. The economy has enough labor, capital, and land to produce 800 bushels of corn. That the velocity, or that V value, is constant. And in 2008, the money supply is $2,000, and the price per bushel of corn is $5. So from this, you can compute the nominal GDP and the velocity in the year 2008. So the answer is that we can say we have all the information up here. So let's calculate. Our nominal GDP is going to be our $5 per bushel times the 800 bushels produced. So measured in dollars, $4,000. The velocity, using our velocity formula, is 2. And so each dollar changed hands 2 times. So we can see the consistency of velocity and nominal GDP. They move in generally the same direction. And velocity is fairly stable over the long run. So because we have a stable number we can rely on, it becomes a really useful thing to understand. So let's go back, and now we're going to take our velocity and we're going to put it into what we call the quantity equation. So in order to make that transformation, we can multiply both sides of the formula by m, and by multiplying by m, it takes it out of the denominator here. So rewritten, it's m times v equals p times y. And we call this the quantity equation. And the quantity theory is this quantity equation, and we'll explain it in 5 steps here. So let's start with that quantity equation. Hopefully you're comfortable with where it came from. So let's assume that velocity is stable. We showed that graphically, that over time it's proven to be a very stable measure. So a change in m is going to cause nominal GDP, which is this P times Y portion, to change by the same percentage, right? Because we're going to assume that V is constant. It's not changing. So a change in M is going to change the total value of P times Y by the same percentage. A change in M does not affect Y by itself. It's going, because money is neutral and Y is determined by technology and resources. So price then changes by the same percentage as P times Y and M. So I hope that makes sense, except we'll get a chance to practice this and I think you can put it all together. Rapid money supply growth causes rapid inflation. So just mathematically, if you look at the formula again, we can say, well, if changing this value of M has the effect on this P only, right? We said that velocity is stable and that Y is determined by technology and resources. So a change in M really only changes P, or the price level. So the connecting idea here is that rapid growth in the money supply is going to cause rapid increases in the price level, which we call inflation. So here's a chance to practice this again. We have the same information. We have 800 bushels of corn that we're capable of producing. We have the land, labor, capital to produce 800 bushels of corn. Velocity is constant, and in 2008 the money supply was established at $2,000 and the price level is $5 per bushel. So in 2009 the Fed increases the money supply by 5%. So instead of 2,000 it's now 2,100. So we're asked to compute the 2009 values of nominal GDP and price level and compute the inflation rate for 2008 to 2009. And then in part B, they say suppose that technological progress causes Y to increase to 824 in 2009. Then find the inflation rate. So some interesting connections here. So let's go through this. You can start to find solutions here by using the quantity theory of money. If we know that P times Y is equal to M times V, we can use this to find the GDP for 2009 pretty easily, because we're told that in 2009 M is 2,100. That's given to us. So we can take 2,100 times 2. We're told that velocity is constant, so we're going to hold on to that. And since P times Y is equal to M times V, we can use the logic here that P times Y is then equal to 4,200. So we have that piece of information. Next, we can solve for P. So if we know that P times Y is nominal GDP and we want to solve for P, then we can just divide P times Y by Y and run through the numbers here. We have P times Y is 4,200. Y is given to us as output of 800, and so we can get the price level in 2009 at $5.25. And finally, the inflation rate is the change between those two values, the price level from one year to the next. So new minus old divided by old is the formula I like to use. The new information here, 2009, is $5.25. The old, 2008, is $5. So we do some simple math there, and we end up with a 5% inflation rate. So to part B, let's assume that technological progress causes Y to increase to 824, and that is a 3% increase. And so now we're asked to calculate the inflation rate. So first, we're going to find the price level in 2009. We're going to use the quantity equation to do this. And now we have that 4,200 from before, except now we're dividing by output of 824. And so now we have a price level in 2009, given this information, of $5.10. So again, we're going to go from 2008 to 2009, $5 to $5.10. And we just do new minus old over old, and we get an inflation rate of 2%. So that takes some practice getting comfortable with the process, but I think it's pretty manageable. Another opportunity to practice here is to understand that if GDP is constant, then the inflation rate is going to be equal to the money growth rate, right? And that should make sense. If real GDP isn't changing, whatever rate of inflation there is going to be exactly the same as the rate of money growth, like we saw in the previous example. If real GDP is growing, then the inflation rate is going to be less than the money growth rate. Again, we saw that in the last problem. Money grew at one rate, and the inflation rate was less than that, right? 3% versus 2%. The bottom line here is that economic growth increases the number of transactions that are taking place, and that some money growth is needed to spur these extra transactions. However, excessive money growth causes inflation. One thing to understand about inflation is there's a condition known as hyperinflation, and this is generally defined as inflation that exceeds 50% per month. And I think anybody would agree that that is a tremendous amount of inflation. And we already kind of went over the principle from chapter 1 that said that when the government prints too much money, prices rise. But we can see that when there's excessive growth in the money supply, you can have this condition of hyperinflation. Some examples of this historically, and not that far distant, is in Zimbabwe. We had huge government budget deficits, and the government, in an effort to correct this, essentially created large quantities of money through their central bank, and this led to very, very high inflation rates. It got out of hand very quickly, and as you can see, in periods in June and July of 2008, they had inflation at an incredible rate. In fact, it's said that it took about 24 hours during this time period for prices to double. And this is a sign that was in one of the bathrooms there. It said toilet paper only to be used in this toilet, no cardboard, no cloth, no Zim dollars, because they had so little value that they were used literally as toilet paper instead. So that's an important thing to understand, that hyperinflation is caused directly by excessive growth in the production or the creation of money, generally by central banks and governments. The inflation tax is the idea that when government borrows to pay for these things, to create all of this additional money, then quite often they print money to pay for the spending. And almost all hyperinflation starts this way. When there is inadequate tax revenue, governments are searching for ways to pay for the things that they want to pay for. They often create money or print money to pay for spending, and this has a really negative effect and can often lead to hyperinflation. Again, we've seen it more recently in Venezuela, and it's happening pretty routinely throughout history. We've seen it. The revenue from printing the money is what we call an inflation tax. The printing of money causes inflation, which essentially taxes the resources of everybody who holds the money and serves as a tax to eat away at the value of the money that people are holding. So in the U.S. today, this inflation tax accounts for about 3% of the total revenue. The Fisher effect is something that we can understand by rearranging the definition of the real interest rate. So we've seen this before. The nominal interest rate is equal to the inflation rate plus the real interest rate, and we have lots of ways we can rearrange that. The real interest rate is determined by saving and investment in the loanable funds market, as we saw in a previous chapter. The money supply growth determines the inflation rate. So two parts of this can be understood. So the equation shows really how we can determine the nominal interest rate. If we already know that the inflation rate is the growth of money and the real interest rate is that market, right, the buyers and sellers in that market, then we can see that what's left to be determined here is the nominal interest rate. So in the long run, money is neutral. We just said that. A change in the money growth affects the inflation rate, but not the real interest rate. And that's that money neutrality. The inflation rate is nominal. It's on its face. We can see it. We can measure it. But the real interest rate is not something that is on its face. The real interest rate is the effects adjusted for inflation. So the nominal interest rate then adjusts one for one with changes in the inflation rate. So as you can see, if we put this together, the Fisher effect says that the nominal interest rate is going to adjust one for one with the real interest rate. And this is called the Fisher effect after Irving Fisher, who studied it. And the close relationship between the variables can be seen very clearly when you put them together. The inflation rate is in red, the nominal interest rate is in blue, and you can see that they move closely together. So it's a one-for-one relationship. The inflation tax applies to people's holdings of money, not their wealth. So it has to do with the spending power of money that they're holding on to. It does not have anything to do with accumulated assets. And the Fisher effect tells us that an increase in inflation causes an equal increase in the nominal interest rate. There's that one for one. And the real interest rate, meaning the rate on wealth, accumulated wealth, is unchanged. The cost of inflation, there's a fallacy that tells most people that inflation erodes real incomes. The inflation fallacy is one that confuses people into thinking that their real income or their purchasing power is always going to be eroded by inflation. But here's the thing. Inflation is a general increase in prices of the things people buy and the things they sell. So remember that people are selling their labor. So generally speaking, as prices for things go up, that also includes the price of labor that people are selling. So in the long run, real incomes are determined by real variables, not the inflation rate. And that's an important thing to keep in mind, because we say the inflation fallacy says that we're always going to be worse off in the long run because of inflation. It's going to erode our real income. But we have to remember that income is also one of the price increases that's affected. And so incomes generally rise in a similar fashion to the prices of things. So if we see here the nominal wage and the CPI, they rise together over the long run. Shoe leather costs are a cost of inflation that is pretty easy to understand. I think it's contained in the name. The resources that are wasted when inflation encourages people to reduce their money holdings. So tasks that people might undertake to reduce money holdings, time, transaction costs, more frequent bank withdrawals, literally the effort and the costs of walking to the bank. Because when your money doesn't hold its value very well, when there's high inflation, you're more anxious to make it go away through spending it, or turning a paycheck into cash so that you can then spend it. Those sorts of costs are pretty common with high inflation. Menu costs are the costs of changing prices, and if you're a business, printing new menus, catalogs, etc., those things are very costly. Another cost of inflation is the misallocation of resources from relative price variability. Firms don't all raise prices at the same time, so relative prices vary, and this distorts the allocation of resources. The confusion and inconvenience, this is also a cost of inflation. It changes the yardstick we use to measure transactions. What is familiar and understandable becomes new and very confusing to people. It complicates planning. Consumers are planners in the long run, usually, and it complicates the comparison of dollar amounts over time. Some tax distortions that come from inflation. It makes nominal income grow faster than real income, right? So we're earning more on paper because our wage is going up with inflation. However, our real income, what we're keeping and what the purchasing power of those dollars is different. And so nominal income grows faster than real income, but our taxes are based on nominal income. and they're not adjusted for inflation. So inflation means that we're paying more taxes even when we have less money that we're able to benefit from, right? Our real incomes aren't increasing, but our incomes on paper are increasing, so we're paying more taxes on those nominal dollars. However, we're not enjoying the benefits of those additional dollars because prices are rising. So here's an example of tax distortion. You deposit $1,000 in the bank for a year, and in the first case, inflation there is none. The nominal interest rate is 10%. In the second case, you've got 10% inflation with a nominal interest rate of 20%. And we're asked to see which case gives us a real value of the deposit that grows the most. So let's assume the tax rate is 25%, and then B asks us in which case do we pay the most taxes. And finally, C asks us to compute the after-tax nominal interest rate, then subtract inflation to get the after-tax real interest rate for both cases. So let's go through these. In A, in which case does the real value of your deposit grow the most? We can do the calculation. In both cases, the real interest rate, right, the nominal minus the inflation rate, is 10%. So in the first case, the nominal is 10%, the inflation rate is 0, we have a real interest rate of 10%. In the second one, the nominal rate is 20%, inflation is 10, 20 minus 10, so the real interest rate is 10%. So for A, there's no difference in the real value of the deposit growth. For B, where do we pay the most taxes? Well, if the tax rate is 25%, let's look at this. In case 1, the interest income is $100, so the taxes would be 25% of that, or $25. In case 2, you have a much higher nominal rate. So you're earning $200, and you still pay that 25%, so you're paying $50 in taxes. In C, compute the after-tax nominal interest rate and then subtract inflation to get the after-tax real, meaning how much you actually keep for both cases. So in case 1, the nominal is 0.75, right? You're keeping 75% times 10%, and you're going to get 7.5% is the after-tax real interest rate. The real is 7.5%, right? That's 7.5 minus the 0% inflation rate, and so you have 7.5%. In case 2, the nominal is that 20% times the 0.75, and so 15%. And then the real, of course, is the nominal minus the inflation rate. So 15% minus 10% gives us 5%. So in which case are you keeping more? The after-tax real interest rate is higher for the case 1 than for case 2. So inflation raises the nominal interest rate, which is the Fisher effect, but not the real interest rate. Notice that. There's that classical dichotomy. It increases the saver's tax burden because even though they have the higher nominal rate, they are paying the same rate of tax, which is a higher amount of taxation on that higher earnings, and it lowers the after-tax real interest rate. So that's an important thing to understand. When you put all that together, it shows a good example of the tax distortions of inflation. A special cost of unexpected inflation is the arbitrary redistribution of wealth, which is the higher than expected inflation transfers purchasing power. So it's a redistribution of wealth as purchasing power goes from creditors to debtors, because the people that benefit from unexpected inflation are borrowers, and the people that lose really when there's unexpected inflation are lenders. So it transfers that purchasing power from one to the other. The debtors benefit because they get to repay their debt with dollars that aren't worth as much. This is going to be a problem when there's high inflation much more than when there's low inflation, And so they're much more likely to have these redistributions when inflation is high. Finally, the costs of inflation are much, much higher in general when economies are experiencing hyperinflation. For economies with low inflation, such as ours, anything less than 10% a year is going to have much less noticeable costs of inflation, although the exact size is open to debate. So the conclusions here are everything that we just looked at, and I will make a subsequent video that covers the homework for Chapter 17, and I wish you lots of luck with this.